So last week I talked about stocks, and today we're going to be talking about how you can make money off of other people's debt or bonds. So let's dive into it. So we're going to be talking about what they are, why people invest, and important things that you guys should know before you invest. So unlike stocks, bonds do not give you ownership. What they represent is a loan from you, the buyer, to the issuer, which can typically be a company or a government or a municipality or an agency. And they're typically issued so, for example, a company can raise capital for projects, operations, or to expand and grow their business. So if you watched my last video, you're probably thinking, well, why have bonds when you have stocks and you can issue those? Well, let's walk through it. Let's imagine you're a company and you're trying to, again, raise capital for a new development. Well, you could issue a stock, which for you is not going to be as risky because the investor is actually taking on that risk. But when you do that, you're also giving up control and ownership of your company. So the other option is to issue a bond. Now, by creating this debt, you're not going to be giving up ownership or control of your company after that amount is paid back in full. Now, you do take on a bit more risk as the issuer because you do have that obligation to pay, but for the investor, they also have a bit more certainty that they're going to get a return because you have a bit more skin in the game. Now, as opposed to stocks, bonds are not going to be meant for appreciation or growth. They're actually a type of fixed income financial instrument, which means that you get a return through periodic, typically biannual payments, and then a return of that full face amount at that maturity date. The maturity date on the bond is going to specify when that principal needs to be paid back or the issuer is going to risk default. So you're typically not going to be benefiting from company growth, but you also aren't going to be impacted as much if the company isn't doing as well, as long as they have the resources to stay current on their loans. So those interest payments that you get on a bond are usually going to be fixed, but also can be variable. Additionally, after a bond is issued, the price in the market is going to have an inverse relationship to market interest rates. So as interest rates go up, bond prices are going to go down and vice versa. So when you're looking at similar bonds, bonds with a short maturity are generally going to be paying lower rates when compared to bonds with a longer maturity. Bonds are also going to be graded based off quality, and they're going to fall into two main categories, either investment grade or junk bonds. And that rating is typically based off of the rating of the actual issuer. So with higher quality or investment grade bonds, they're typically going to be paying lower rates. And with lower quality or junk bonds, they're typically going to be paying higher rates. A great way to wrap your mind around this is about thinking about people on the individual level. So let's say you have a higher credit score. You're typically going to be paying lower rates on any debt that you take out, as compared to someone that has a lower credit score, you're going to be paying higher rates on any debt that they take out. So, as I mentioned before, bonds are not meant for appreciation or growth. So typically, investors are usually going to invest in bonds when they're looking to create steady, predictable income or to offset some of the volatility in their overall portfolio. And when it comes to issuers of bonds, you have many different issuers. Some of them are the US Treasury. You also have government agencies like Fannie Mae or Freddie Mac. You can also have a municipality like the City of Richmond or individual corporations like Boeing Company. Finally, you have different types of bonds. You have zero coupon bonds, which don't make periodic interest payments over the length of that bond. You actually earn your return by buying that bond at a discount, and then at maturity, you're paid the full face amount. So for example, you may buy a bond at $500, and then after 5 years it matures and you're paid out $1,000. Then you also have convertible bonds, which can be converted into equity in the company. Then you also have callable bonds, which means the issuer of that bond can actually call that bond back before its maturity date, and when that happens, interest rate payments are going to stop. Then you also have puttable bonds. That means that you, as the holder or buyer of that bond, can actually put it back to the issuer, getting your full face amount before the maturity date. So as you guys can see, this stuff can get pretty complicated. So I have some advice for you guys. If you're not working with a trusted and reputable professional, don't invest in things you don't understand. Most people just hear something, do a little bit of research, and then end up investing. Typically that's more of an emotional decision, and they usually don't end up getting the results they're looking for, or they end up doing much worse than they could have in the end. So the best way to do it is to really create a comprehensive financial plan, something that's going to be based off your goals in the long term, your investment time horizon, and also taking into consideration the risk level that you're comfortable with taking on. So talk with your financial professional, or feel free to reach out to us. We have a link down below in the description if you guys want to book a meeting. Hopefully this was helpful and you guys learned a little bit during our two-part series here.